Good evening, everybody. Nice to see you all. Hope you all had a good July 4th weekend. You're healthy and ready to begin the midpoint of our Accounting 203 class. My name is Professor Hassey, and tonight is midterm examination week. The midterm will be posted at the 7 o'clock hour to Blackboard. It covers chapters 1 through 6. Welcome to the Funhouse. Tonight we're going to talk about specifically two problems. One representing retail journal entry accounting, problem 5-1A, and one representing inventory valuation under the Fifo and Lifo inventory valuation methods in chapter 6, problem 6-1A. Then we'll have a brief review of the midterm and go on our merry way this next week of doing our midterm examination. Before we get started, I'd like to review a couple of things that you need to do, or some of you need to do, in the next few days over the weekend. Is in our Blackboard account under class discussion forum. We have some students who have indicated to me their project paper. And here is that listing of those students who have indicated to me their desire for the company to work on, and we'll talk more specifically about this next week as far as the 10K and how to read it and how to prepare for this. Some of you might be able to, and probably can start it this week, but the midterm will probably occupy the majority of your time. But remember, we have to pick a Fortune 500 company that you will download their 10K and answer some questions in regards to their financials. And as we indicated last week, this is a way of indicating of our learning the real world in financial statements, the end result of accounting entries and the accounting cycle. Some of you have chosen manufacturing companies like Tesla. Some of you have selected entertainment companies like I would call Facebook, Facebook and Disney. Some of you have looked at technology companies, conglomerates, different types of companies. So if you do not see your name on this list, please let me know by the weekend your paper topic. It gives me an idea how to prepare for next week in talking about helping you do these papers. So please do that over the weekend and post to this discussion forum your company that you have selected. Remember, we can only pick one. There's no doubling of companies. So these companies selected by your fellow students can no longer be selected for our group. So please take care of that in this next few days. Thank you. Let me just take a look at our group tonight. Everybody's looking. Who I do see is, I can tell they're really looking forward to this class this evening. Well, what can you do about it? Such is life, such is college. So let's get at her. As we talked about last week, we're learning retail accounting, which is a little bit different from the service accounting that we have talked about through chapters 1 and 4. It's how to record entries when you purchase a product from a vendor and then resell that product to your customers. It's called retail. Two key points of these chapters 5 and 6 that we're going to practice tonight, and they are also on your midterm examination, is how do you record these entries for a retail manufacturer? How do you record the purchase of the product? How do you record the selling of the product? How do you record, as we talked about last week, any changes Sales returns, purchase returns. If you do not like the product you purchase, or the customer that you sold it to does not like the product they purchased, how do we account for that? All leading to this slide I have on your screen showing what retail accounting is all about. The recording of sales minus the cost of the goods that you sold, which equals the gross profit of the company. Then you minus the expenses of the company, wages, supplies, depreciation, insurance, whatever, to get the net income. The key difference in this is you have to make sure you record now for every sale, there's also a recording of the cost of goods sold. You have to record the expense of purchasing the product that has now been sold. Before that product is sold, it is sitting in an inventory account called merchandise inventory. You purchase the product from a vendor and put it in inventory. In Chapter 6, we learn how to account for the value of those inventories differently, that the Internal Revenue Service allows us to calculate inventory values differently. And we'll be concentrating specifically on the Fifo and Lifo methods of inventory valuation. We also talk about in Chapter 5 two different systems of recognizing inventory. One is called the periodic system, and one is called the perpetual system. In this class, we will be using the perpetual system of inventory. After every transaction, you know the balance in your inventory account. The periodic inventory method is just taking the inventory recording or entry at the end of a period. We will not be studying that, and you're not responsible for that. It's the perpetual inventory system we will be studying in this class. And here's that flow chart that we looked at last week. You purchase your inventory plus what you start out the period with, beginning inventory, and that's merchandise available for sale. At the end of the period, you have some inventory left over. That's an asset called ending inventory. What you sold is an expense called cost of goods sold. Beginning inventory, purchase new product, available for sale, ending inventory, what you sold of product. A very simple way of doing that is I started out with 5 units of product. That's my beginning inventory. I purchased another 5 units at the beginning of the year. I now have 10 units available for sale. During the course of my accounting period, I sold 7 units. If I had 10 units available for sale, that means I sold 7 units, that means I have 3 units in ending inventory still available for sale, and I sold 7 units, and that's my cost of goods sold, whatever I paid for those units. So you're keeping track of the inventory. And if any of you work for retail companies or manufacturing companies that sell a product that they either purchase or produce, inventory is a big deal for a lot of companies, keeping track of it. And we talked about that little method of when you go to the store and you purchase a product and you go take your product to the cash register and to pay for it, and the cash register clerk runs it over a barcode reader and it goes beep. That beep does a journal entry just like what you're doing in problem 5-1. That beep automatically records the sale and the expense of the cost of goods sold of the product you just purchased. That's what that barcode reader does. Beep. That's the automatic computerization of that transaction. In this class, there's no beep. We have to do the entry. So that's a brief overview of what we talked about last week. Now let's see this in application. let's see this, how this works in our journal entry format. Now remember, our midterm exam is covering 6 chapters. One question is doing the accounting cycle, recording journal entries, recording, posting them to a ledger that I provide for you, and we'll see that in just a minute later on, and then recording an unadjusted trial balance, then doing adjusting entries, and then posting those to the journal and preparing an adjusted trial balance, and then preparing the 3 financial statements: income statement, statement of owner's equity, and the balance sheet. And then the preparation of closing the temporary accounts, the closing entries, and putting together a final post-closing trial balance. That's the accounting cycle spread out over 4 questions on the midterm. Then you have a question on the subject we're talking about right now, recording retail journal entries. That's all you have to do. Just record the entries, nothing else. No posting, no trial balance, no nothing. Just record the entries. Chapter 5-1. And then after our break in the 7 o'clock hour, we'll talk about inventory valuation. No journal entries, just calculations. Problem 6-1. That's the midterm examination. I strongly urge you is to break that examination up into parts. Do the first 4 questions, the accounting cycle, first. Get it out of the way. You have quiz number 1 and quiz number 2 as your templates. I provide you with a general ledger that you can just post. The accounts are all set up with empty accounts. All the accounts you need are already set up. You just have to post them to the proper account. And then when you're done with that and it all balances and you're very happy, then you can do chapters 5 and 6 questions. Do not wait till Wednesday evening next week, July 15th, and try to do it all in one sitting. It won't work. Break it up. It'll be a lot easier. It won't wear on your mind. You'll be a little bit more better prepared for that. It'll work itself out. We have office hours next Tuesday afternoon from 3 to 5, where you can ask me questions about the midterm, but I will not look at any of your samples and say, oh, that's good, that's bad, you're on the right path. This is a midterm, none of that. You can ask me questions about the subjects, but I won't tell you whether you have it right or wrong. Sorry. If you can't see me next Tuesday afternoon from 3 to 5, you can make subsequent appointments at any time if you need to talk to me, or you can email me questions. But I will not review your work. You have perfect templates in quiz 1 and quiz 2. You have perfect templates in 5-1 and 6-1. We're going to do 5-1 and 6-1 in class. The solutions are already in Blackboard, but we're going to do them by hand here in this class tonight to show you the flow. So let's turn to page 204 of your text, problem 5-1A, and let's take a look at that. Page 204 of your text, problem 5-1A. And here it is right here on your screen, if any of you need to see that. We're recording the merchandising transactions for a company called Cabela, which uses the perpetual inventory system. We are going to record these entries for the various dates located here. Okay? For July. July 1 through the 31st. This is an excellent problem to review the type of entries to record for journal. This is what the beep does when you purchase a product from a retail store. It does many of these transactions. We talked about these transactions, the definition of the transactions last week. Now we're actually going to do the transactions this evening. So if you want to follow along with me, fine. I will post the solutions in a spreadsheet format, but the solutions are also posted in Blackboard. Let me show you where those are. If you go to Blackboard, week number 5, first of all, the spreadsheet that I'll be filling in this evening is right here, week 5 in-class review. Right now, this is blank, and I will be filling it in and then posting as I fill it in after class. That could be a nice spreadsheet in a spreadsheet format for these problems. At the bottom of that file folder is the review problems answers, chapter 5 and 6. You can download those, and those have the answers to those problems as well. So that's what we're talking about this evening. By the way, these are a couple excellent videos explaining FIFO and Lifo inventory valuation. If you have yet to see those, that would be a good thing to review as you get prepared for chapter 6 question. Okay, so you know the text 204. We have the problem. Let's do it. That's not it. That's your midterm. We'll take a look at that later. There it is. Okay, sorry. So many files. Here's problem 5-1. We're going to go right down the line on this and do each problem, each transaction, to make sure you see it and understand it. And let's start off with July 1. Purchased merchandise from Bowden Company for $6,000 under credit terms 1/15, N/30, FOB shipping point, the invoice dated July 1. Wow. In English, what that means is we're buying $6,000 of inventory on account, credit, accounts payable, and we have 15 days from the date of that invoice to get a 1% discount if we pay it to Bowden Company in 15 days. If we can't meet that discount period, we're going to pay it the net amount due in 30 days. Those are the terms of the agreement with our vendor, Bowden Company. So the entry here then is, we're purchasing inventory, merchandise inventory. That's a debit. We're owning the asset, $6,000. At the same time, we incur a liability, accounts payable, $6,000. We purchased it on credit. We have it due in 30 days. But if we so see it, we can pay that by July 16th, we can take a 1% discount. We talked about this last week. July 2nd, we now sell some merchandise. Sold merchandise to Creek Company for $900 on credit. Oh, they're going to owe us the money. $900 on credit. Their terms to pay us are 2/10 and over 60. The invoice was dated July 2nd, but here's the key part of the second part of this problem. We sold it for $900, but the merchandise cost us $500. So the entry to record the sale, accounts receivable. They owe us $900. And we record the sale, that's a revenue account, $900. They owe us the money. They have 60 days to pay us. Boy, are we nice guys. But there's a second part of this entry. We have to record the expense of cost of goods sold of $500 and now reduce the inventory account by the sale by crediting it $500. For every revenue transaction, a sale transaction, you have to record the sale, be it receivable or cash, and the expense of getting rid of the product at your cost. Right now, at the end of this transaction on July 2nd, we have a gross profit of $400. We have sales of $900. We have a cost of goods of $500. Our gross profit is $400. We also know that we have $5,500 in inventory. We purchased $6,000 and now we've sold off $500 of that. We now have $5,500 in inventory. That's why this is called the perpetual inventory system. We know at the end of every transaction how much we got in inventory that has yet to be sold. July 3rd, we paid $125 cash for freight charges on the purchase of July 1. On the $6,000 purchase, we now have to pay freight charges for that product. Because this is a perpetual inventory system, those freight charges are not called freight, they're added to the value of the inventory. Debit, merchandise inventory, $125. And credit, how did we pay for it? Cash, $125. We're increasing the value or the cost of our inventory. Why? Because we had to pay in, not only we had to pay the vendor $6,000, we also had to pay the shipping. That's what that FOB means, freight on board, meaning you who are buying the product have to eventually pay for the freight when you get the bill. One of the attractiveness of Amazon.com, right? When you buy something for them, it's free delivery. They pay for the freight. You don't have to worry about it. Now, really, they incorporate that in the cost of the product, but let's not quibble about that. But if Amazon said you have to pay the freight charges, you have to pay $10, that's another example of freight on board. You, the buyer, in addition to buying the merchandise, you have to pay the delivery charge of it coming to you. That's what this example is of here. But when we pay it under the perpetual system, we have to record it as an additional cost or value of inventory. All right. July 8th. We've been around the block now on this. Let's choose somebody from our distinguished group. Aubrey, since you have the camera on, I'm going to pick you. Do you have your textbook available? You can see this?
I do.
All right. Why don't you try doing the transaction for July 8th? Sold merchandise that had a cost of $1,300 for $1,700 cash. What would be the entry to record that sale? Very similar, but not exactly, to the July 2nd transaction.
Okay. So if it sold merchandise, that had a cost for 13. So sold merchandise that had cost 13 for 17.
So what's our retail price?
Is it 1700 or yeah, 1700?
Very good.
Okay.
So how would we record that sale?
Would it be accounts receivable?
Does it say anything about selling on credit there?
No.
What's it say?
Sold for cash.
There you go.
Okay. So if it's merchandise inventory, right?
Yep.
Do we have to throw that in?
Eventually, but let's record the sale first.
Okay. So cash of 1700 for debit. And at this point, would it be merchandise inventory?
No, don't we have to record the revenue?
Yeah.
What would that be?
Accounts receivable.
So we're crediting accounts receivable?
No. I'm looking.
What did we do up here for this sale?
Oh, sales.
There you go.
There we go.
Credit sales.
Okay.
$1,700. Very good. And then now record the merchandise inventory at cost.
Okay.
Can't hear you. Okay.
So merchandise inventory. Oh, let's see. I'm looking at cost of goods sold. And if it was 1300, so did we earn 400? Is that? Do we have to?
We did earn 400, but we have to tell our accounting system how we got to that $400.
Okay, so then we would put cost of goods sold was 1300.
Very good.
Yep. And then merchandise inventory. Oh, well, wait. Yeah, merchandise inventory would be 1300 as well under credit.
Very good.
Okay.
There you go. Good job, Aubrey. All right. Good job. No, that's good. All right. Very good. So what did we do? Just like we did on July 2nd, we recorded a sale. And this time the sale was for cash, and it was a little bit more, $1,700. So debit cash, we receive cash, and we have to credit sales. That's our retail selling price. That's our revenue. And then now, remember, every sale transaction in retail accounting has to record the expense of the product that you sold.
Great.
So they tell us in the problem, it cost us $1,300 to sell it at $1,700. So we expense debit cost of goods sold, and we now lower our inventory balance by $1,300 because we now have sold that and it's no longer in inventory.
Great.
Excellent. Good job.
Thanks.
Good job. All right. Good job. All right. Let's look at July 9th. Now we're purchasing some more merchandise. Does it ever end, this accounting? It never ends. We purchase merchandise from the light company for $2,200 under the credit terms 2/15, N/60, FOB. Invoice is dated July 9th. Now notice here it says FOB is from the destination, not from the shipping point. So we don't have to pay freight for this one, because when it says destination, it means Light is going to pay for that product delivery, kind of like Amazon. So our transaction on July 9th is to debit merchandise inventory, because we're buying more inventory for $2,200, and we're buying it on credit, so that's the old accounts payable. We owe the money, $2,200. And that's the entry for that one. Cool. July 11th. Ooh, there's always these thrown in that drive us bananas. You know how I got my gray hair? It was these entries right here. This is how I got my gray hair. Look at this. Look at it. That's how I got it, by these friggin' entries here. They gave me my gray hair trying to sort these out. So, July 11th, we returned $200 of merchandise purchased on July 9th from the light company and debited its accounts payable for that amount. So we got that shipment on July 9th from the light company, and it was delivered, and we opened up the boxes and said, wait a minute, $200 of this is lousy. We're going to return it back to the company. We're not paying for this. That's called return merchandise. Matter of fact, just yesterday, I got something from a purchase that was delivered to me, and it was the wrong size. Since I'm so skinny these days, I had to send it back. So when I sent it back and contacted them online, they credited my credit card. They reduced my bill because I'm sending back and shipping back their product. Just like this. So what's the journal entry to record that? Well, first of all, we have to lower our accounts payable by the $200. Oops. By the $200 of returned merchandise. So debit accounts payable, $200. And now we have to credit merchandise inventory, because we're sending that inventory back. So it's now no longer inventory that we own. We're reducing the inventory balance by us returning that inventory back to light company because it was lousy, and we're lowering our bill that we have to pay them. Debit accounts payable, merchandise inventory credit, that's for returned merchandise. I mean, you know what would be a good idea here, just so you could have this for reference when you look at these. This is a purchase. This is a sale. This is freight. This is a sale. This is a purchase. And this is a return. That might help you with that, putting there in that column. Thank you, Mr. Hassey. You're cool. All right. That gives you a little, okay, this is an example of a be nice if I could spell. This is an example of a purchase. Oh, and this is an example of a sale with a receivable. This is an example of if we have to pay for the freight. This is an example of a sale with cash. Got that one. This is a purchase again. And this is we're returning something. Cool. All right. July 12th. Received the balance due from Creek Company for the invoice dated July 2nd. Net the discount. Oh, here's another gray hair. We're now paying this during the discount period. Okay, we're paying this during the discount period. Let's go back to July 2nd and take a look at that entry. Remember here, we were purchasing $900. We were selling $900 on accounts receivable. Now they're going to pay us for that $900 now on July 12th. All right, cool. But remember, that purchase is within July 2nd to July 12th. That's 10 days. They're going to get a 2% discount. They're paying us within the 10-day discount period. and they get a 2% discount. What's 2% of $900? Well, I'm so sophisticated, I can do this in my head. $900 times 0.02 is 18 bucks. $18. So now we're going to record cash received $882 debit. We're now getting a discount called sales discount, $18, which is a 2% of $900. And we're going to wipe out the receivable accounts receivable, $900. This is called receiving or giving a sales discount. Let's see, let's look what we did. We sold a product on July 2nd to this company called Crate Creek Company. $900 they purchased from us. They owe us the money. They have a discount period of 10 days. They get 2%, net 60. So on July 12th, they send us a check for $882. Why 882? Because they're paying within the 10-day discount period, July 2nd to July 12th. So $900 gets a 2% discount. That's 18 bucks. And we record the entry by wiping out the $900 of the sale, the receivable, but we only receive $882. The rest is called a sales discount, which is a debit account keeping track of all the discounts we give out to our customers who pay within the discount period. This will lower our revenue. What does that mean? Well, notice we have revenue here of $900. We have revenue here of $1,700. That's $2,600 in sales. So if we were doing an income statement, we would have sales at this point, $2,600. That's our total sales up to this point in time. But then we would pay, say, less discount, and we would subtract from that $18 because that account has a debit balance. So our net sales would be on our income statement $2,582. That's how it would look on the income statement. Because we're showing, yeah, we sold $2,600, but we gave one of our customers, because they paid us quicker, we got the money quicker, which is, I like that, at 2% discount, so that's a debit. Notice sales is a credit, sales is a credit. The discount account is a debit because we're going to be reducing our total revenue because we gave $18 back to our customer for rewarding them for paying us early. That's how that works. People do this for a living. Yikes. I'm going to stop right here and save this file, and I see I have 2 chat questions here. Let's see how many people have decided to say accounting is not my career. Oh, Ashley is here. Thank you, Ashley. Ashley told me she was going to be a little late tonight. Ashley, nice to see you here. Get ready, because in about 10 minutes, I'm going to ask you to do one of these journal entries as your penance for coming a little bit late. So Ashley, here we go. Be ready. 10 minutes, though. You got time to relax. Take a little shot of whiskey, whatever you want to do. You got 10 minutes. So be ready, Ashley, and welcome to our class. Thank you. All right, let's get back to this. July 16th is our next transaction. Let's see what's going on here. July 16th. Paid the balance due to Bowden Company within the discount period. Paid the balance due to the Bowden Company. All right, this is for the purchase that we made way back on July 1, right here. Remember this transaction, the $6,000? That's to the Bowden Company. And remember that transaction had a 1% discount if we paid it within 15 days. July 16th is 15 days. So we get to pay, we get a 1% discount. So $6,000, 1% is, let's see, $6,000 times 1%, that's 60 bucks. So we're going to do an entry to debit accounts payable because we're now paying that bill. So we're going to wipe out the accounts payable, $6,000 debit. We're going to credit merchandise inventory, lowering our inventory because we're taking a discount because we're paying it back early. 1% of $6,000, that's 60 bucks. And we're writing a check for the cash to the company Bowden for $5,940, taking off the $60 discount. So we're lowering the inventory balance because that inventory of $6,000 only really cost us $5,940 because we paid it within the discount period. So now we're accounting for that when we make the payment. I got a stomachache. I don't know how much longer I can take of this. But I'm also got a chills. I got chills. This is so exciting stuff. So that's the recording of a purchase. We did the buying, a purchase discount. Okay. Cool. How can accounting be cool? I don't know. All right, July 19th. And Ashley, this is where you go to work. July 19th, we sold merchandise that cost $800 to Art Company for $800. That cost us $800, and we sold it for $1,200 with a discount of 2 over 15 and over 60. So we sold merchandise for $1,200. It cost us $800. Ashley, let it loose.
I came a little late to class. I just got off work.
I know, that's why.
First off, what page are we on so I can try to catch up to? I don't know what page we're on.
Tell you what, Ashley, we're on page 204.
Okay.
Problem 5-1, and let me do this problem, and then I'll ask you another problem in about another 5 minutes. How's that sound?
Okay. Well, I can take a guess. Would I put 800 under debit for starters, and then would you follow up for a credit of 1,200, or would you just subtract the math before that?
None of the above.
Okay. Well, then come back to me.
Okay. All right, Ashley. Remember, we're selling something for $1,200 that had a cost of $800, and we're selling it on credit. So accounts receivable. Debit, $1,200. Credit sales. Oops. $1,200. Remember, we're doing the selling here, and that's revenue. Now we have to record the cost of that merchandise. Debit, cost of goods sold, $800. And credit merchandise inventory, $800, lowering the value of our inventory because we no longer own it. We have just sold it, and that's why it becomes an expense on our income statement, cost of goods sold. We sold it for $1,200. It cost us $800. We have a gross profit just on that transaction of $400. This is another example of a sale. Okay. July 19. Ooh, here's another gray hair one. July 21. Gave a price reduction allowance of $100 to Art Company for the merchandise sold on July 19th and credited Art's accounts receivable for that amount. All right. In other words, they maybe returned some of that product to us and said, "Hey, you guys, this stinks. We want a credit. We want We don't want to pay you for this. $100 of this is lousy. It's like taking clothes that fit back to the store. They'll give you a credit. Either they'll give you your money back or they'll credit your credit card. All right, they're returning merchandise that we sold them. How much was it? $100. All right. So we have to do an entry. Called it sales returns. Debit. $100. And credit accounts receivable to lower the bill that they owe us. $100. Okay. And this is called a sales return. Return of merchandise that you sold, and you're crediting their bill, and sales returns is $100. Notice up here on July 12th, that was a sales discount. This is a sales return, 2 different accounts. Okay. July 24th. Paid light company the balance due net discount. We remember the light company was when we purchased merchandise on July 9th for $2,200. And we owe that money for $2,200. So now we have to pay that bill to the light company. But remember, back here, we returned $200 of that on July 11th. This is where the gray hair comes from. You really got to keep track of this stuff. So we only owe them $2,000 because we purchased $2,200. We returned $200 here, lowering the accounts payable to $2,000. Now we're paying it within the discount period. So we get a 2% discount on the $2,000. The original purchase of July 9th said if we pay within 15 days, we get 2%. Well, the 2% now is on $2,000 because we returned $200 bucks. So 2% of 2,000 is $40. So July 24th. We're now going to wipe out the accounts payable by debiting it. $2,000. We're going to take a merchandise inventory adjustment credit for the discount of $40. And we're going to write a check for cash for the difference, $1,960. We're paying off the bill, but since we're paying it off within the 2% discount period, we can deduct 2% and only pay them $1,960. The credit will go to reduce the value of the inventory because it's lowering the value of the inventory because we're only going to pay $1,960. This is an example of a payment. A payment of merchandise. Okay, cool. July 30. 2 more to go. July 30. Receive the balance due from Art Company for the invoice dated July 19 net discount. Receive the balance due from Art Company for that July 19th sale. Remember July 19th, we sold $1,200 to the Art Company. We sold $1,200. Remember they returned $100 and we lowered their receivable by $100. So they really owe us $1,100. They're paying us within the discount period, and the discount on that sale was 2%. So we take 2% of $1,100. That's how much they owe us. And if my math is correct, that's 22 bucks. 2% of $1,100, $22. So debit cash $1,078. Debit sales discount, giving them a discount of $22. And wiping out the accounts receivable that they owe us of $1,100. And that's another example of a sales discount. They purchased $1,200 from us. They returned $100 here. They owe us now $1,100. They're paying us within the discount period, so they get a 2% discount on $1,100. That's $22. We wipe out the receivable, and they pay us and give us a cash for $1,078 as payment on that purchase. Wow. July 31. Ashley, why don't you lead us into the break? If you can do this transaction. Sold merchandise that cost $4,800 to Creek Company for $7,000. It cost us $4,800. We're selling it to Creek Company for $7,000 on credit. Talk to me, Ashley. Talk to me.
So you're going to credit the $7,000?
What would we credit? Correct.
The merchandise inventory? Or
Nope, because we're
sales?
crediting 7,000. That's our sale. That's our retail
Sales.
price.
Okay.
Remember the example up here when you first came
Yeah.
on? Here's a recording of a sale on credit. There's the
Okay.
retail price, and there's the cost. Go.
Okay, accounts receivable, and then underneath is going to be where the sales goes.
Why don't we talk in accounting language?
Accounts
Debit accounts receivable.
receivable.
$7,000.
Okay, so I thought you said debit. Okay, and then sales is going to be debit $7,000.
Credit 7,000. It's revenue.
The sales is?
Yeah.
Oh, okay. All right.
And then we're going to record the cost of the sale by debiting the expense account cost of goods sold for the cost given to us as $4,800, and then crediting merchandise inventory now to lower our inventory balance because we have sold $4,800 of stuff for $7,000.
Okay. Huh.
Ladies and gentlemen, Madame and Messieurs, it's 7 o'clock. Do you know where your accounting mind is? It's right here, problem 5-1. We just recorded samples of purchases, sales, freight, returns, discounts, and payments for a retail company. Amazon does this 200 million times a day. Costco does this 775 million times a day. I looked this up. I'm rounding. Walmart does this 66 million times a day. These are the entries, the basic entries to record retail sales and purchases. You will have a problem exactly like this. The names and the numbers have been changed to protect the innocent. In the midterm, this is your template, but understand what it means, and then you'll understand how to do the entry. But this is your practice problem. Pretty cool.
Commissioner Hesse?
Yes, Jessica.
On the last one for July 30th, that would be a sale, right? On the
This
side
one
where you-
here?
Yeah. Well, on the 31st.
That's a sale. Excuse me. Yeah. All right. I forgot to write that there. That's a
No
sale.
worries. Thank you.
There you go. Okay. I know that helps you guys when you take a look at that. Okay. So I'm going to save this and I'll post it to week 5. So you have this lovely template. Okay. And there you go. All right. Save it. So let's take a break. You've earned it. You now know everything it is to beware of in accounting for retail inventory. I'll see you guys back here at 7:15 or 15 minutes past the hour. Have a nice break. Smoke them if you got them. See you in 15 minutes. Bye. Get out. Leave. I don't want to see you. Bye. Welcome back. Great music. Unbelievable music. Great music. We have a poll. Our Accounting 203 has a poll. Let's see if we can do this. Our preferred method of inventory is periodic, annual, perpetual, none, straight line. What is our preferred method of inventory? We talked about this in the beginning of our class, and we're going to be looking at this again in the second half of our class. You have 2 minutes. This is for a grade. No, it's not for a grade. This is just a fun thing. I don't even know who's answering. This is just a fun thing.
I don't see it.
It says here, attendees are now viewing your questions. You don't see that?
No, I don't have anything on my screen.
Elijah, do you see it on your screen?
I believe I did answer already.
So you answered it, okay. Jessica, did you answer it already?
No.
I seen it earlier and I answered it already, so I don't see it now.
Once you answer it, you won't see it.
Okay.
If you minimize it, does it go away?
It's away now.
Okay.
It's back. Oh, well. Well, we got 11 out of our 14 students have answered. Thank you. It's not one thing, it's another, Jessica, huh?
It didn't come back up on my screen.
Thank you. Now you should see the results of our poll. We have, the question was, our preferred method of inventory is, and it looks like the majority of our class said perpetual, which is exactly right. Perpetual inventory, meaning we're recording an adjustment to the merchandise inventory account after every necessary transaction, as which we just did in problem 5-1. So this doesn't mean anything. It's just a little fun thing to do coming out of a break. So don't worry about it if you didn't see it or didn't do it. The earth will not shatter, so it's okay. But so perpetual inventory is what we're doing in our class. Okay, that's that. All right, so we're now going to concentrate on this. In chapter 5, we recorded those entries and they gave us the cost of the inventory when we sold a product. Remember those transactions of we debit cash and credit sales and debit cost of goods and credit inventory. The cost of goods and the credit to inventory is the cost of the merchandise, $800, $1,200, whatever is given to you in the problem. In chapter 6, we learn how to calculate the cost of the merchandise. How do you calculate the cost? And this, where this gets a little confusing, and I'll go through it as slow as possible for you, but we're referring to our text here, chapter 6, page 248. Chapter 6, page 248. Problem 6-1A. Now let me explain to you what all this mumbo jumbo is. The Internal Revenue Service, the tax people, allow retail companies to determine how they calculate their cost of goods, their inventory. You can pick a variety of methods. You select that method on your tax return, and that method is going to be used by your company for the next accounting or 12-month period. Why do they let you do that? Because some companies have different ways and different things to do with their inventory or with their product they purchase. It comes in at different times of the year. It can come in at different prices. It gives you the opportunity to take a look at that valuation. In my introduction video tonight, I had a statement from our publisher, the writer of this text, defining inventory valuations and how it influences the cost of recording inventory. We're going to learn two methods tonight, Fifo and Lifo inventory valuation. It sounds like cereal, Fifo and Lifo. Oh, what do you want for breakfast, honey? Oh, I'll have Fifo today. What the hell, man? No, it's not a cereal. Fifo means first in, first out. Goods purchased first of an accounting period are the first ones sold out. Last in, first out, Lifo, again, not a cereal, last in, first out, is goods purchased last in your accounting cycle are the first ones sold. It means a way of calculating and valuating inventory based on how you determine what you think is best. First in, first out, or last in, first out. Problem 6-1 is an example of this. All right. Now, I'm going to be perfectly honest with you, like I always am. After this midterm, you're never going to see Lifo and Fifo again unless you're a CPA. All right. You're never going to see it again. But if you're going to study retail accounting, you have to know something about how the inventory is valued. And if somebody says, hey, Elijah, you studied retail accounting from HASI? Yeah. What do you remember about that? He was always talking about these Lifo and Fifos. And the guy goes, oh yeah, that's right. What does that mean, Elijah? And Elijah would say, that's a way of measuring the value of the inventory. That's it. Elijah's perfect. Now he doesn't have to worry about that anymore for the rest of his life. But if any of you are in the retail business or thinking about being in the retail business, how you account for the receipt and accounting of your merchandise, Fifo and Lifo are tools that you will use. All right. So here we have a problem on page 248 where this company uses the perpetual inventory system, has a beginning inventory. This is all the same product, mind you. It's the same product. It could be a widget. It could be whatever. On March 1st, at the beginning of their month, they had a beginning inventory of goods, of units that they've already purchased in prior periods of 100 units at $50. Then on March 5th, they bought 400 more units of the same product, but now the price went up to $55 a unit. Okay. Then on March 9th, they sold some product, the same product. They sold 420 units at $85 a unit. excuse me. On March 18th, they had to purchase 120 more units. Now the price went up to $60 a unit. March 25th, they purchased an additional 200 units at $62 a unit. Same product. The price is going up. And then on March 29th of this accounting period of March, they sold an additional 160 units at $95 a unit. Notice during the course of the period of time, they're increasing their retail price to keep that margin of profit stable when the price of the product is going up. And this happens. If you're working with a vendor or a group of vendors, by the supply and demand of the product, the market you're in, the industry you're in, prices change rapidly during a period of time. If you're in this rapid changing product time or rapid changing price, you want to find an inventory valuation that suits you based on this. But the bad thing about it in the real world, you have to declare this before, at the beginning of your fiscal year, before you really know what the prices are going to do during the year. You have to go by history. What's the history of your purchasing of these products? Do they usually go up during the course of the year? Maybe Fifo is our method, or Lifo. Our job in this problem is, first of all, in part one, determine the cost of goods available for sale and the number of units available for sale. Compute the number of units in the ending inventory. And then we're just going to concentrate on compute the cost of this ending inventory using Fifo or Lifo. Don't worry about the other two methods. Lifo and Fifo are the big dogs. Page 248, exercise 6-1. So I went ahead and set up our spreadsheet that's going to be posted back to Blackboard. And here it is right here. I've gone ahead and set up the spreadsheet exactly like the problem is on page 248. There's our beginning inventory of 100 units at $50 a unit. There's the total dollar amount. There's our purchase of March 5th, 400 units at $55. There's the total amount. March 18th purchase of 120 units at $60. Total amount. March 25th, purchase of 200 units at $62 a unit. There's the total amount. So question number one is, how much do we have available to sell? Well, it's the total. We had a beginning inventory plus additional purchases totaling $46,600. And we had a beginning inventory of 100 units plus additional purchases totaling 820 units available for sale. Well, then they told us in the problem that we had two sales. Remember that? On March 9th and March 29th. We sold 410 units and 160 units. That's 580 units total. So if we had 820 units available and we sold 580, that means we have 240 units ending inventory. Our job as Professor Hasse Accounting 203 students is, what is the valuation of those 240 units? What is the dollar value of those 240 units? Okay? That's our job. That's your job. You have a problem very similar to this in the midterm. Your job, there's no journal entries like we did in chapter 5. All you have to do is come up with the dollar amount, and the first step would be using Fifo. Then the next step would be using Lifo. First in, first out. Last in, first out. Do that, and we can determine the ending value of these 240 units. We sold these. We've had available this. What is the dollar value of 240 units? That's our question. You need to solve these two numbers. Okay? That's the exercise. Now, why friggin' is this important, Mr. Hassey? The point of it is you have the option of selecting one or two methods, and it's going to change the total value of the numbers by your selection. And here's how we do it. Here's that part on that spreadsheet I just did. 46,600 total available for sale, 820 units total available for sale, 240 units of ending inventory. This is taken out of the problems posted in Blackboard that you have. Now, what is the ending value of these 240 units using FIFO? The answer is $14,800. $14,800. That's the ending value of those 200 units. That's what that means. Now, here's how we calculated it. Remember I said goods purchased first are the first ones out. All right, FIFO. So notice, we have a beginning inventory of the $5,000. We purchased 400 units on March 5th. Now we have a total inventory of the 5,000 plus the 22,000. We now have $27,000 in inventory. Then on March 9th, we sold 420 units. Now, first in, first out means those 100 units of inventory have been sold now. Notice 100 units at $50 is $5,000. That's the cost of that sale, cost of goods sold. Then the next 320 units of the 420 is at $55 a piece. That's at $55, that's $17,600. So our cost of goods sold would be these two numbers, $22,600. What's left in inventory after that March 9th sale is 80 units at $55. The 100 units of beginning inventory are sold and gone. All that remains in inventory is 80 units at $55, $4,400. How you know you're right? Add 4,400 plus 22,006, and you should get $27,000. That's how you know you're right. Then on March 18th, we purchased another 120 units at $60. That's $7,200. So we have the 80 units at 55 still in inventory, plus now the 120 units at $60. That total now is $11,600. Then we purchased March 25th another 200 units at $62. We add that to our $11,600. We now have $24,000 in inventory under the FIFO valuation. March 29th, we now sell another 160 units. But we have to go back to the first in, first out. What was the next inventory available was these 80 units at $55. So we're selling those 80 units as part of this 160 unit sale of March 29th. 880 at 55, that's $4,400. Then we're going to sell 80 units of the next purchase, the $60. 80 units of this 120 are now going to be sold at $60. That's $4,800. So what's left in inventory at the end of this cycle We have 40 units of the $60 purchases still in stock right there. And we have the 200 units purchased on March 25th still in stock. So that's 40 at 60, 200 at 62, or $14,800. What we now know is also that this 4,448, this is our cost amount. That now totals $31,800. That's our cost of goods sold. What's left is $14,800. You add the two together, that equals the $46,600 of available for sale that we started out with. So the answer for FIFO is $14,800 is our inventory value still in our inventory at the end of the period. And our cost of goods sold for this period is $31,800. Remember those two numbers. Now, here comes the gray hair. I kind of get that, Mr. Hassey. I kind of get it. But now here comes the gray hair. Now let's do this for LIFO. Notice our numbers change. Our inventory is now not $14,800. It's now $13,680. That must mean our cost of goods sold is higher, $32,920, because they still have to equal $46,600. But how did I get that $13,680? Same procedures right up to this point, $27,000, but look how I handle the March 9th sale. The March 9th sale is of 420 units. So now we assume of the 420 units, 400 of the March 5th purchase is sold. Last in, first out. It's a little different. And that 20 units of the $50 beginning inventory is sold. What's left in inventory at the end of the March 9th purchase or sale? 80 units at $50, $4,000. Our total cost is $23,000. 23 plus 4, we match. Then we buy the March 18th purchases, same as usual. The March 25th purchases. But now we take a look at the March 29th sale, 160 units. Last in, first out says we have to take the 160 units from the last purchase, the 200 units at $62. So our cost of goods sold is 160 units times $62, the last purchase made of that accounting period, which is $9,920. So what's left? If 160 of the 200 units, that means 40 units at 62, 120 at 60, and 80 at 50. $13,680. Because last in, first out always takes the most recent purchases according to the sales date, our inventory has dropped versus FIFO. Thus, our cost of goods sold has gone up. The answer to the problem, Mr. Hassey, is inventory under FIFO is $14,800. Inventory under LIFO is $13,680. These are the two methods you're going to have to worry about in your midterm, and there's a template for you there.
In what real life aspect would we use LIFO over FIFO?
Depends on the company and how. For this company, they would probably use. It depends though, because do you want to show making you're going to make more profit under FIFO because your costs are lower. You're going to make less profit under LIFO, and the reason for that is because your purchases increase over time. The cost of the purchases increase over time. 50, 55, 60, 62. So under LIFO, those early purchases have the higher cost. That's why you have a higher cost of goods sold. So if I was a company, Elijah, to answer your question, if my merchandise purchases during a period of time increase over time, they go up after every buy, I would probably use the FIFO method because then I'm showing more profit. And vice versa. If inventory costs or the cost of the vendors goes down, then I would probably use LIFO. It depends on the circumstances. That's a great question. That's exactly how you would handle it. But again, here's another example. Some companies might pick LIFO because they don't want to pay, remember that with a higher cost of goods sold, they're making less money. They don't have to pay any more taxes. The tax liability is lessened. It depends on the company, but most retail companies, especially these days, would want to pick the inventory method that shows them the greatest profit. And in this case, it's FIFO. Here's a quick little note you can make for yourself. If inventory is higher, your cost of goods is lower. If inventory is higher, your cost of goods is lower, thus your profits are greater. If your inventory is lower, your cost of goods is higher and your profits are less. That's a tough thing to remember, but if you do this a lot, and you guys will not, this is a one-time deal, but if you go to somebody who runs a retail company and say, hey, what are your inventory costs? What's your inventory values? Are they dropping or going up? They're dropping. Well, that means you're going to have higher expenses. Cost of goods sold are going to be higher. But a company can track this during a year and see what's the best method to get the results that they want. More profit, less profit, LIFO or FIFO. But it depends on the string of payments, if they go up or down, of the product you're purchasing. You know, a lot of product is cheaper in the winter months and the spring months, and it gets more expensive in the summer or fall, or vice versa. It depends on your product, your industry, your market. And that's why the IRS gives you these options to select what suits your company better. That's problem 6-1A, and that's what you need to know about that. Thank God, Mr. Hassey, you're recording this, and I can go back through this later. Okay, that's that. Let's bring this up. I'm in our Blackboard site, and here is the 5th week of our class and the halfway mark, and you're probably saying, good God, do I have to keep looking at this for 5 more weeks? Help me, Lord. But if you go to Blackboard now tonight and you go to quizzes and examinations and open up that file folder, you'll now see a midterm examination file folder with 4 files. And I'm going to explain those files to you. If you go scroll down, you'll see the solutions are posted to quiz number 2 and quiz number 1. All right. This exam is due Wednesday, July 15th at midnight. Ladies and gentlemen, Madame and Messieurs, I would like you to try to stick to that due date and time. I'd like to limit the amount of extensions if possible. If you need it, you need it. No worries. But I want to try to get the grades back to you, because midterm grades are important. Get the grades back to you by that Friday or Saturday of next week. But again, if you need extra time, you need extra time, and I'm not going to punish you for that. But just so you know, it's due midnight next Wednesday. Okay. Now, I've given you 4 files. First of all, the problem files describing the problems are the first 2, the PDF and the Word doc. Here it is right here. Okay, this is the work file. I would probably anticipate you should do all your work in a spreadsheet file. Okay? If you don't, that's fine. It's just a hell of a lot easier, and you'll see why in just a minute. So I give you a company called Reggie Dunlop. Here's the company's chart of accounts, all the accounts that you will need for this problem. I'll say that again. Do not create any accounts on your own. You're only going to use these. You're going to be recording the original journal entries for the month of March. You're going to post those to a general ledger and then prepare an unadjusted trial balance. We've seen this before. But what you haven't seen is this. I have given you a general ledger file in a spreadsheet ready for you to post to. You don't have to worry about setting this up. You can just download this spreadsheet and fill it in as you record the entries. Mr. Hassey? Thank you. I want to keep this fairly simple. I want you to concentrate on the entries. I don't want you to worry about drawing little stupid T accounts and figuring this stuff out. Notice I have every account listed. All you have to do is fill it in and determine the balances. Okay? Now, I've given you this in 2 formats. A spreadsheet, which I highly encourage you to use, but I also gave it to you in a PDF version. Some of you like to use PDFs, I don't know why, but I do give it to you in a PDF version. What I would do if I were you is download this spreadsheet and then create, watch what I'm doing here, create other tabs and do the other journal entries and problems in those tabs, and everything is all now on this general ledger spreadsheet, which you will save as Jessica's midterm, which you would save as Michelle's midterm, and then post it back to Blackboard. But you decide about that. You do whatever you think is best, but here I have a spreadsheet that's ready to be posted from the journal entries that you do right. Where'd it go? There it is. Right here. Okay? So again, I say, do not worry about the general ledger. All you have to worry about is posting to the ledger. It's already there for you with all the proper accounts and everything. If you do a journal entry and you have an account that's not listed in that general ledger, you did something wrong. Okay? So that's the first part. You record the journals. I want to see a journal entry. You post them to that ledger, and then you prepare a trial balance. Once you have that unadjusted trial balance, then you do these 5 adjusting entries, just 5, and then post them to the trial, post them to the ledger, and prepare another trial balance. Then you prepare an income statement, a statement of owner's equity, and a balance sheet. You've done this before. Make sure you have the proper headings. You shouldn't have to worry about anything not balancing if your adjusted trial balance is balanced at the end of your adjusting entries. I do not want to see a worksheet. I want to see journals and the trial balances in separate tabs. I do not, I repeat, I do not want to see worksheets. That's not the real world. I don't know why the text gives it to us. Do not do worksheets. Some of you did for quiz number 2 and I let it go. It will not be accepted on the midterm. no worksheets. Geez, Mr. Hassey, take a chill pill. All right. After you do those 3 financial statements, then prepare the closing entries and the post-closing trial balance. You will now have completed the accounting cycle for Reggie Dunlop, and you have it completed. That would take you an evening to do, one evening. Then at the end of that evening, you have a nice Diet Coke. You celebrate the balancing of all the accounts in this accounting cycle, and then you go to the next question about retail accounting. And these are the journal entries just like we did in 5-1. Prepare the journal entries May 1st to May 17th. Then I have a fun little thing that'll drive you pretty crazy, is here's an income statement for a retail company. Sales, where'd cost of goods sold? Cost of goods sold is right there. Gross profit, operating expenses, net income. But notice A, B, C, D, and E are blank. Your job is to take the information in this income statement and find the blanks. 1, 2, 3, 4, 5 numbers I'm looking for. Fill in the blanks to make these 2 years of income statement items equal. I mean, as far as do the math. Remember, sales minus cost of goods sold equals gross profit, minus operating expenses equals net income. Boy, that's a tough one. So I want you to do that as the second part of this question for retail accounting. Gives me an idea of your ability to understand an income statement for a retail company. And remember, this is all also in your textbook, the same thing. Then we get to the final question, and I ask you to record the inventory valuations under Fifo and Lifo for this company, just like we did in 6-1A. Tell me what the ending inventory value is for the amount of units. You're going to have to determine how many units have been purchased, how many units have been sold. The difference is how many units is the ending inventory. And then from that, I want a dollar value of the inventory. Now remember, I want 2 numbers. Determine the cost assigned to the ending inventory and the cost of goods sold, just like we did in 6-1. That's it. That's enough. That's it. You get through this, you're ready to move on in our class. This is a midterm of the material we've covered these first 5 weeks. Quizzes 1 and 2 are the template for questions 1 through 3. Problem 5-1A for question 4, 6-1 for question 5. And this one you're on your own, the second part of question 4. Difficult? A little bit. Exciting? Of course. Thrilling? Not so much. But this gives you the base by which accounting and understanding the language of accounting is all about, and you'll be prepared with a couple more adjustments in the second half of our class to move on to business finance next term with maybe, knock on wood, Professor Hassey. If not, I love you. Okay, there we have it. Again, this material is in your Blackboard under the midterm examination headline. 2 files are the problems. There's my general ledger spreadsheet right there. And there's the PDF version of that for you PDFers out there. But this spreadsheet is all ready to go to format for your answers. If you have questions during the week, I will help you. But I will not say, you cannot send me your file and say, Mr. Hassey, does this look right? No, I'm not going to answer that. Mr. Hassey, did I do this calculation right? This is what I got. I will not answer that. If you ask me questions about how something is done, I will help you. But I will not confirm or deny any of your answers. That's why this call is called a midterm, and it's worth 25% of your course grade, 1/4. And don't forget, sports fans, pick a paper topic. Some of you have yet to do that. There it is right there. If you don't see your name there, I need a topic from a Fortune 500 company by the weekend. Thank you. So there we are. I can't think of a better way to celebrate mid-July than doing a midterm examination in accounting and beginning the work on a paper. Mr. Hassey, relax, will you? All right. It's the 8 o'clock hour, and I am done. Any questions from the audience, please? Aubrey, is your sister from Boston still here? Where'd you kick her out?
Nope, she's still here.
What a deadbeat. Get her out of here. You got to do a midterm.
It's okay. She takes my kids and we trade off. So.
Oh, good for you. That's
yeah.
good. Jan Lee, you're on an iPhone, which would make it very difficult to see some of the material posted tonight. I would strongly urge you to review the recording of this lecture later on, okay?
Yeah, I did pinch and zoom in, and if you flip it to the side, you can see the full spreadsheet. So I was able to see it all.
And now your eyes are probably tired. Okay, thank you. That's okay. Now I'm going to be shutting down in just a minute, but I will stay on. If anybody has any specific questions they want to ask me individually, you're more than welcome to do that. I will post this video of our lecture probably by tomorrow at the noon hour. And then you're off and running for the next week. Remember, we have office hours next Tuesday. If you want to come on and ask any questions, and as you probably are coming to the end of your work on the midterm, or if you have any questions or concerns about picking a company for your paper. You guys have done good. You really have. I know a lot of your heads are spinning and you're going, how am I going to get through this? You guys have done very good through the first 5 weeks. This is not easy stuff. It's a new language. You're doing fine. Take a deep breath and you can do this very nicely. Have confidence in yourself because you have all the material available for you to review. All right, guys, thank you very much. I am going to shut down. If you have any specific questions, I will hang on until everybody is off. Blanca, it's always good to see you, dear. Michelle, I didn't see you tonight. You're hiding behind the sunset, I guess. Everybody have a, oh, I know you are. I just don't see your pretty face. All right, so thank you, everybody. Have a great week. Deep breaths, yoga, go to church on Sunday, and you'll get through this examination. Thanks, everybody. Have a good rest of the week, and I'll talk to you later.
Thank you. You too. Good night.
Adios.
Hey, Professor Hassey, how's it going, sir?
Brian, I'm fine, thank you. Just got off work, huh?
No, I actually, I was trying to get internet from my house. I had to drive over to my girlfriend's house, no Wi-Fi, so.
Okay. Well, I've
Yeah.
recorded everything.
Yeah, I'm gonna revisit. So.
And you can go over everything. If you have any questions after you see it, just let me know. Okay, Brian?
Definitely. And we've got 1 week to do the midterm.
Yeah, it's due next Wednesday night at midnight.
Sounds good. Sure.
Okay.
I'm actually gonna look into getting a tutor. It's been very difficult for me to register these accounting.
Sure, Brian. Let me tell you. If you go to the syllabus that I gave you,
Yeah.
at the ending part of the syllabus, I give you some areas where you can get help, and one is called the Academic Success Center on campus.
Mm-hmm.
They have tutors there to help you with this class. You
Okay.
either you can send them an email, you can call them, you can go online and see them and make an appointment with them, and they can come to you online, they can come to you over the phone. But there's graduate students there who have taken this class, many from me,
Yeah.
who are tutors, and you can go to the Academic Success Center for free and get help about this.
Okay. Yeah,
Great.
that's what I need. And sir, just so I know, did you go over the last quiz?
I did.
Okay, that's what I need. And because every time that I practice, I get better, but I feel like I always need more practice. So if there's also more work that I can do, you know, just to get like practice questions, I would love to do that. So.
Also, Brian, did you look at last week's class video?
Mm-hmm. I
Okay.
watched it, but it was, like I said, well, it registers when I'm talking to you and I ask you questions.
Okay. All right. Well, just go through it. The solutions are there for quiz 2, so you have those. And you might want to go over that quiz with somebody from the Academic Success Center. They know how to do that. So if you want it, but also I'm available if you need help. But you know, our schedules are kind of tough with your work schedule. But
Actually, oh yeah. Well, I'm working from 6 to 2 o'clock next week, or 6 to 1. So if you have any availability after that, I would love to.
just send me an email or a text, and let's see if we can get together. Okay.
Okay, appreciate it. Thanks, Professor Hasse.
All right, Brian. Take care. Have a good week. And there we have it. Week 5 here from Mission Control in Claremont, California. This is Professor Hasse wishing you happy, but always watch for those credits. Adios. What a geek.